When we talk about bank de-risking or debanking, we're really using a banking term. And the banking term describes a phenomenon in which banks who have previously categorized their population as low, medium, or high risk are opting to exit relationships with those customers that they perceive as being high risk, or opening up any risk exposure or vulnerability to money laundering or terrorist financing to that particular institution. When those banks are shedding client after client, whether that is an individual or a trade company or a business of some sort, there does appear to be an aggregate effect. So we're seeing a shift of clients who are categorized as high risk by one bank continue to be described or categorized as high risk by other multiple banks. In essence, we're taking out this aggregate risk, and those clients are finding themselves bankless, without a bank account, without access to services. And rather than maybe use the term de-risking, which again is a banking term, we look at another term, which is re-risking, shifting the risk from the financial institution out into the shadows or out into the margins. And in those margins, we're really risking pushing high-risk clients into an informal economy, contributing to a potential expansion of a black market, a shadow market. And in that sense, we're really removing our own visibility into transactions that we currently have while those high-risk customers are within the formal banking system. There's minimal evidence base, empirical evidence base for the phenomenon of bank de-risking. The reason we don't have an empirical base is because the information is aggregated within individual banks and kept within their records that are not publicly shared or not necessarily shared with governments. More so, there's a difference in how data is collected across different jurisdictions, different countries, different banks, different regulators, different multilateral organizations gather information differently, and there's no one consistent way to gather data. And so we don't really know what the scope or the extent of the problem is. Unfortunately, we're relying on numerous bubbles of anecdotal information that are coming out from a variety of different actors. We're seeing the discussion of de-risking taking place across central banks. We're seeing the discussion on de-risking and its impact on regulators globally. We're seeing it affecting correspondent banking relationships. We're seeing it across the board with exporters and importers, and unfortunately there's no one point of empirical evidence collection. For example, if you were to attend a conference, whether it be on financial inclusion or whether it be on anti-money laundering and counter-terrorist financing, you're going to hear different perspectives related to de-risking and how it's impacting those particular sectors, but you're not necessarily going to have much solid evidence to go on, which is partially the reason that we don't see much action, because we can't seem to get a handle on what the problem really is, how big is the problem, and how do we effectively troubleshoot that problem when we can't describe it in numbers. When it comes to talking about solutions for bank de-risking, there are three immediate solutions that I put out on the table. The first one being focused around dialogue and trust building. The dialogue at the moment is really focused in the financial sector. That needs to be, first of all, expanded and shifted into the foreign policy sphere. De-risking is a foreign policy matter, and foreign policy experts are not at the moment at the table where these discussions are being had. So we need to have financial institutions join up at the hip with the foreign policy experts to have that discussion. The second solution is around know your customer. The guidance around know your customer is extremely broad at the moment and not quite tailored to the immediate operating realities on the ground for low capacity countries in emerging markets. Emerging markets really struggle to apply know your customer principles because they may not have a national identity system. They may not have the technology that they need to demonstrate reinforcement, and we need to really take the KYC policy and adapt it to that particular context. The third solution that I like to put on the table is around enhanced due diligence. So banks are guided to identify their high-risk clients. Banks know how to do that, and they do that very well. The guidance they're lacking is what do they do next? Each individual bank at the moment is opting to interpret how they ought to go above and beyond enhanced due diligence, and that's what they do. There's no standard uniform guidance on how to implement enhanced due diligence globally. that's something that we need to be providing for, including adjusting enhanced due diligence for those low capacity countries and emerging markets. The sophistication of the banking risk scoring models really needs to be addressed. Banks should look at how it is that they perceive risk and how it is that they assess for it within their own portfolios. And once they've identified those risky clients, they need to look beyond a solution of severing relationships. Not only could that potentially be profitable for them, but that particular request to regulators to bank high-risk customers is really an expansion of the dialogue that needs to happen between regulators and financial institutions.